Hi, everybody. This is the investing teacher, high school science teacher, teaching others how to invest. Please ignore my little slight laryngitis here, so Texas allergies not going well, but let's try to explain this as best I can with my voice. Just like my iffy voice, the stock market has been pretty iffy for quite a few people. Big jumps up and big jumps down. But I'm going to show you the possibly favorite strategy that I like, which is a Iron Condor that's really far out in expiration. And we're going to look at a 3 month or 90 days out expiration. We just had quad witching day on Friday, so you could easily do approximately 90 days starting on Monday on March 21st. I'm going to go over what the Iron Condor is and how to implement it using SPY and possibly SPX with different account sizes. As always, click like, subscribe. I'm going to do a little bit more regular updates, and let's get right to it. Alright, so we're going to be implementing an Iron Condor, which is a put credit spread and a call credit spread at the same time on SPY. This is a good way using a smaller account size. You could do this with as little as $500 to earn premium on theta decay. Essentially, we're going to be picking really far out of the money puts and calls. We're going to sell those, and then you're going to buy the put and call a little bit beyond it. So then you'll be taking advantage of theta decay as SPY stays within those two lines. The theta will drop, and then eventually you can get a good return on it. I like really longer DTEs, especially in this environment with a high VIX. It's in the 25 area or so. So you could actually make money when the VIX decreases because implied volatility is lower. And if not, you could just wait it out a little bit longer until the strike prices start to narrow down and get even. So when you're looking at the Iron Condor, you could see that the actual strike prices should be really far away from support and resistance lines, which we're about to cover. And then also you want to get a decent return for the amount of risk that you're taking. So let's first go over what an Iron Condor is and how to implement it. For Iron Condor strike prices and possibly how to manage them if it doesn't go your way or if you want to take profits early. So Iron Condors are a good way to sell premium on stocks or ETFs that don't move a ton up or down. SPY has been moving quite a bit, but implied volatility has been lower in the 25 area compared to the low 30s. So there's a chance it may not move as much up and down. There are a few events currently with Ukraine and Russia, interest rates and whatnot to be aware of. But as you'll see, we're going to be selling really far out of the money strikes. So you're going to do a put credit spread and a call credit spread on the same position and same expiration. So typically for Iron Condors, I like to look at least 1 month out. The recommendation we're going to give will be 3 months out. So you have plenty of width in the strikes and a good chance for it to expire worthless. It is a very small cost. It's just the width of your spreads. So if you sold, say, a 400 put and then bought a 395 put, subtract those two numbers, you get 5, and it'll only be a $500 cost to actually implement this trade. One side is guaranteed to work in your favor. So if you're selling the 400, buying the 395 puts, and then selling the 480, buying the 485 calls, obviously we can't go to 400 and 380 at the exact same time. So one side will work out, and that actually does help with our stop losses and premium collected, because you'll earn the premium on two different spreads. Some of the negatives to this to be aware of: you can hit your max loss, which would be the width of your spreads. If you sold the 400, bought the 395, and it goes below 395, you would lose $500 minus your credit that you received. They're a little bit tougher to manage because you have to worry about the call side and the put side. And the position can go against you in two different ways, obviously, if it shoots way up or drops way down. So how do you scan for a setup on the Iron Condor? This is what I like to use on Thinkorswim. You can find a stock or ETF that's range bound. You can typically use a standard deviation. Here under added studies, I do standard deviation of 2, which is really far away. It's usually about a 0.0506 delta. And then you could sell a put or call credit spread. at 0.05 to 0.1 delta because that gives us a very good cushion in case it goes against us. And as you'll see, you get really high premiums off it. Now, how to manage it? If the position is staying pretty much range bound, it doesn't go up or down a lot, you could consider to buy to close it at about a 75% profit if you'd like. You could also wait until expiration, but I tend to see you get a slightly higher return if you buy to close it a little bit early and then just start a new one right afterwards. If your stock goes towards the put or call side, you can leave the other side alone and then stop loss or roll the challenge side. That means you would move the strikes out further away. So let's look at the SPY. It's the S&P 500 fund. And this is the 3-month chart going back to end of last year into March 20th is when I'm doing this video. The lines that I put on the top and bottom were where it touched. And then you can see the high on January 4th was 749.98. And the low was in February 24th at 410.64. So all I did there is I drew a line at the bottom point, drew a line at the top point. There are some pretty dramatic ups and downs here. So going from 480 to 410, you went down close to 20% from the top to the bottom. Right now we're currently sitting at 444.52, which is pretty close to the middle of these 2 points. So I think it might be a good time to do an Iron Condor. We could sell a put credit spread down here and a call credit spread up here. Let's look at what the amounts that you'll get. So if you're 444, the 410 put would be a pretty good starting point to look at. And then we'll go 5 strikes down on it. So let's go out to a 3-month expiration. That'll be June 17th. And we're going to go to the 410 strike. Double check on this. Yep, 410 strike. It's a little bit riskier than what you normally look at because the delta is 0.25 here. But 410, you're going to sell that put. You're going to buy the 405 put. And you'd receive $90 in credit from a $500 buying power that you need. Okay. On the call side, you could go around 480 or so. Delta's a little lower on that side, 0.17. If you do 480, 45, it went up to 175 credit, so 175 bucks off $500 if it doesn't touch either of these 2 points at expiration. So that's a pretty risky play in my opinion. I'd rather go even further away from these lines to give even more safety, especially in this pretty high volatility environment we're in. It's at 23.87. So we're going to go and let's look at the around 0.4, let's do around 0.05 delta. Super safe. Delta column here, looking at the 0.05. Go all the way down to 330. I'm going to sell the 330 put, buy the 325 put. You get $13 in credit. And go on the other side, 0.05 in the calls. Go around 500 or so is 0.06, close enough. And then, so you're selling the 500 call, buying the 550 call, and you get a credit of 0.34. So $34 divided by the $500 max loss that you have, and you're looking at a 6.8% return in 3 months. Not the end of the world. It's actually a pretty good return in the end. We're looking at 2.26% per month return. And if you could consistently do that, you're going to make about 30% a year off this position, off a very, very far away strikes, 500 and 330. I would have to move the chart back more and add another line here to show it. Here's your 500. Get another good cushion. 330, I'm going to move the chart really far away so that I could show you some of the safety of this possible position. Here's your 330 line. Much lower than that low of the year. I would probably want to go a little bit higher delta though to get a little bit more return. That still has some pretty safe strike prices. Let's look at the 0.1 delta. Then around 365, sell the 365 put, buy the 360 put, and you get a $32 credit. On the call side, if you go 0.1, you get 490 to 495. And then you're getting a $76 credit. So 365 and 490 are right here. Still way below the low of the year. And we're looking at 490, which is over here. Still a decent amount above the high of the year. Let's zoom out a little bit more. We could look at the yearly chart instead of the 3-month chart. In the yearly chart, the high was 478. It went down to the 400s all the way in May of last year. And the low of the whole year was 383. So that's why I think that put side is perfectly fine going around 360 or so. All right, so in summary, about an hour or two after market open on 321 Monday, we're going to look to sell about a 0.1 delta 365 put, buy the 360 put, and also sell the 490 call, buy the 495 call. Look for a premium of about $75. 75 divided by 500, which is your max loss, looking at a 15% return in 3 months. And you could easily try to buy to close that earlier if you'd like, before waiting the full 3 months if you could get the target return that you'd like. So again, I'm the investing teacher, high school science teacher, teaching others how to invest. We do run an alert service on thetatraders.com. That's thetatradererz.com, where we do cash secured puts, we do credit spreads every day, have a Discord where you can ask me any questions, and a pretty active group there. So if you're interested, leave a comment down below, and see you guys next time.